Today I'm going to give a brief presentation on the chapter 3 with the title Financial Instruments, Financial Markets and Financial Institutions. On this presentation, I will talk about the key notions such as differences between direct and indirect finances, the relationship between the financial development and economic growth, and the role of financial system. Second, I will discuss the use of financial instruments, especially the use for transfer of risk. I will talk about the notions of asymmetric information and the paradox of leverage. And lastly, I will talk about the shadow banking system. I will start with the difference between the direct and indirect finances. In the direct finance, the asset holder has a direct claim on the borrower, while in the indirect finance, the asset holder has a claim on the financial institution. For example, suppose that a company wants to raise $5 million to expand its business operations. First, the company can issue $5 million in bonds. This is a direct finance with no middleman between a borrower and the lender. Second, the company can go to a bank for a $5 million worth of a loan. Well, in this case, there is a commercial bank between the borrowers, who are the households, individuals who are depositing their money to this commercial bank, and the lender, which is this company who is expanding its business operations. Okay, second, a country's economic growth is linked to the financial market development. For the level of economic activity rising, the financial system must grow, otherwise the country will stagnate. It's not unreasonable to say that there's a positive and there's a strong positive correlation between financial market development and economic growth across countries. This is because the financial system lowers the transaction costs, provides better allocation of resources, prevents domestic savings costs, and helps individuals manage risk. Needless to say, the financial instruments are useful as a medium of exchange, such as currency. Second, it's useful as a store of value, such as bank loans, bonds, home mortgages, stocks, and asset-backed securities. I think asset-backed security is more interesting than all the other instruments in this section. An asset-backed security provides a yield return on a specific asset like housing loans and car loans. For example, a mortgage-backed security diversifies a plenty of mortgages into a pool, divides it into the tranches according to its riskiness, and then sells the share. Remember that some fraction of mortgage-backed securities turns out to be toxic in the recent financial crisis, and this means that some borrowers couldn't repay their mortgages, couldn't pay their housing loans due to the price falls in the housing market, and therefore this creates a panic in the financial system. Third, financial instruments transfer the risk like insurance contract, futures contract, options, and swaps. In an insurance contract, such as health insurance, car insurance, house insurance, or disability insurance, the individuals transfer the risk to the insurance company. Second, a future contract is an arrangement to swap a fixed amount of commodity or an asset at a fixed price determined before the date of transactions. This instrument basically substitutes the risk of price fluctuations in the market from one party to another. Lastly, a swap is used to exchange two specific instruments at a specific date. The idea in the swap is to transfer the risk of interest rate fluctuations in the financial markets from one party to another. Asymmetric information is one of the most important financial friction in our financial system. Asymmetric information occurs when a borrower misrepresents what she will do with the borrowing. Financial institutions come up with precautionary measures against asymmetric information. Well, for example, a life insurance company makes individuals having a physical exam before agreeing to provide life insurance. In this case, the company wants to eliminate the information asymmetry concerning the general health of the individual. Similarly, the commercial banks have strong monitoring technology before giving private loans or credit cards to the individuals. Lastly, the use of borrowing to finance an investment is called leverage. The borrowing in the financial system is almost a must in modern economies. This means that all the transactions are basically leveraged. If one individual borrows more to make the same investment than the other individual, then he is more leveraged and hence he has less net worth. However, when all the financial institutions avoid leverage simultaneously or they deleverage at the same time, the result is counterproductive. This is because the asset prices will fall because everybody wants to deleverage at the same time, and hence their net worth will diminish. Therefore, the assets become too risky. This situation is also known as the paradox of leverage, and this is exactly what happened in the recent financial crisis in 2007, when when the companies, individuals, the financial agents in the financial system observe that the mortgage-backed securities are backed by subprime mortgages, then the financial institutions start deleveraging at the same time, and this results in the fall of asset prices, fall of mortgage-backed securities in this case, and the panic arises, the liquidity dries up, and as a result of this, financial system collapsed. The lack of regulations in the United States result in the emergence of the so-called shadow banking sector. This entails hedge funds, insurers, brokerages, and investment banks. They compete with traditional banks as a financial intermediary. To be more specific, a traditional bank makes maturity transformation by taking a short-term deposits from individuals, households, and issuing a long-term loan to a firm. However, a shadow bank makes liquidity transformation by purchasing a liquid asset and issuing new illiquid asset-backed security. Well, it's important to note that the US government doesn't provide insurance for large amount of deposits in the case of commercial banks default. And also the fact that the traditional banks are regulated by the US government induces commercial bank depositors to make less profit. Because the shadow banks, so-called shadow banks, were not regulated before the financial crisis, they have taken large risks, which eventually led to the collapse of the financial system. Since they were less transparent, they are literally called shadow banks. They are also called unregulated banks or unconventional banks. Uh, some examples of shadow banks. To give an example on shadow banks, a hedge fund, for instance, pools the resources of its wealthy customers and invests them in a portfolio. Comparing the two countries, Canada and United States, the volume of transactions that take place in the shadow banking sector is substantial in the United States relative to the Canada. As a result of this, the Fed has intervened in the shadow banking sector by purchasing assets backed by subprime mortgages during the financial crisis. Another important detail is that the federal home loan banks, which are regional based institutions that provide loans to the low income mortgage borrowers, they account for majority of lending in the interbank market or federal funds market in the United States today. Just because the shadow banking sector has great significance in the US, the Fed has to introduce a new monetary policy tool called reverse repurchase agreements to control the federal funds rate or overnight interbank rate. This is because the interest payment on excess reserves or the interest payment on the central bank deposit was not a sufficient tool to control the interbank activity.